Do you know, smart personal finance requires the implementation of techniques such as budgeting, building an emergency fund, paying off debt, wisely using credit cards, retirement savings, and more. We will go through all the details of budgeting in this video to help you with the personal finance, and we will also suggest the correct ways in which you can use the credit card and have a good credit score. So watch this video till the end. Welcome to our channel, Data is Everything. Today we will discuss about the 10 personal finance strategies. First, let us know, what does personal finance? Personal finance is a term which covers both the management of your money and saving and investing. This involves budgeting, banking, insurance, mortgages, investments, planning for retirement, and tax and estate planning. The word often refers to the entire industry that provides individuals and households with financial services and advises them on financial and investment opportunities. Personal finance is about achieving personal financial objectives, whether it's sufficient for short-term financial needs, retirement planning, or saving for college education for your kids. It all depends on your income, expenses, living needs, and individual goals and desires, and a strategy to meet those needs within your financial constraints is being created. It's important to become financially literate in order to make the most of your income and investments, so you can differentiate between good and bad advice and make wise decisions. The earlier you start financial planning, the better, but it's never too late to build financial goals to provide financial stability and independence to yourself and your family. For personal finance, here is our list of best practices and tips. 1. Devising a budget. For living within your means and saving enough to achieve your long-term goals, a budget is important. A great structure is provided by the 50-30-20ths budgeting process. It breaks down as follows: 50% after taxes, that is, of your take-home pay or net income, goes into living essentials, such as rent, electricity, food, and transport. 30% for lifestyle costs, such as eating out and apparel shopping, etc. 20% goes to the future, paying off loans and preparing for both retirement and emergencies. 2. Build an emergency fund. To ensure the money is put aside for unforeseen expenses such as medical costs, a major car repair, rent if you get laid off, and more, it is important to pay yourself first. The ideal safety net is between 3 and 6 months' worth of living expenses. Every month, financial experts normally suggest putting away 20% of each paycheck, which you've already budgeted for, of course. Once your rainy day fund has been filled up for emergencies or sudden unemployment, don't stop. Continue to direct the 20% each month into other financial targets, such as a retirement fund. 3. Limit your debt. It sounds clear enough: do not spend more than you receive to prevent debt from getting out of hand. Of course, most people have to borrow from time to time, and if it contributes to purchasing an estate, going into debt can also be beneficial. One good example is taking out a mortgage to buy a home. But leasing, whether you rent a home, rent a vehicle, or even get a subscription to computer software, can often be more economical than buying outright. 4. Use credit cards wisely. Credit cards can be a big trap for debt. But not owning any in the contemporary world is impractical, and they have purposes other than as a tool to purchase items. They're not only important to setting up your credit rating, but they're also a great way to track spending, which can be a major help to budgeting. Credit just needs to be adequately handled, which ensures that the balance can preferably be paid off each month, or at least held at a minimum rate of credit usage, that is, maintaining your account balances below 30% of your total available credit. Given the exceptional benefits for rewards available these days, such as cash back, it makes sense to charge as many transactions as possible. Still, at all times, prevent maxing out credit cards, and still pay bills on time. One of the quickest ways to destroy your credit score is to pay bills late, or much worse, skip payments on an ongoing basis. Another way to guarantee that you will not pay for accrued small transactions over an extended period, with interest, is to use a debit card. 5. Track your credit score. The primary vehicle by which your credit score is established and retained is credit cards, so monitoring credit spending goes hand in hand with tracking your credit score. You'll need a good credit background behind you if you ever want to secure a lease, mortgage, or some other form of funding. How long you've had credit, your payment history, and your credit-to-debt ratio are factors that decide your ranking. The calculation of credit scores is between 300 and 850. One rough way to look at it is, 720 equals good credit, 650 equals average credit, 600 equals bad credit. Set up direct debiting where possible to pay bills so that you never skip a payment, and subscribe to monitoring agencies that offer regular reports of the credit score. 6. Consider your family. To protect the assets in your estate and ensure that your wishes are followed when you die, be sure you make a will and, depending on your needs, possibly set up one or more trusts. You also need to look into insurance, auto, home, life, disability, and long-term care (LTC) insurance. And be sure to periodically review your policy to make sure it meets your family's needs through life's major milestones. Other critical documents include a living will and healthcare power of attorney. While not all these documents directly affect you, all of them can save your next of kin considerable time and expense when you fall ill or become otherwise incapacitated. And while your children are young, take the time to teach them about the value of money and how to save, invest, and spend wisely. 7. Pay student loans off. Graduates have various loan repayment options and payment reduction methods available. If you are stuck with a high interest rate, it will make sense to pay off the principal more quickly. On the other hand, lowering repayments, for example, to interest only, will free up other earnings to spend elsewhere or put into retirement savings while you're young and get the full value from compound interest. If the borrower enrolls in auto pay, certain federal and private credits are also liable for a rate cut. Flexible services worth trying out for federal reimbursement include: graduated repayment raises the monthly payment gradually over 10 years. Extended repayment delays the loan for a period of up to 25 years. 8. Plan your retirement. Retirement may sound like being away for a lifetime, but it comes much earlier than you might anticipate. Experts say that in retirement, most individuals would need about 80% of their current salary. The younger you start, the more you profit from what advisors like to call the magic of interest compounding, how small amounts develop over time. Setting aside money for your retirement now not only helps it to expand over the long term, but if funds are put into a tax-advantaged account, it may also reduce your current income taxes. 9. Understand tax breaks. Many people leave hundreds or even thousands of dollars sitting on the table every year due to an unnecessarily complicated tax code. You'll free up money that can be invested in the elimination of past debts, your enjoyment of the moment, and your aspirations for the future by maximizing your tax savings. For all potential tax deductions and tax credits, you need to start saving receipts every year and monitoring expenses. Many business supplies stores sell helpful tax organizers that have already pre-labeled the key categories. You'll want to concentrate on taking advantage of any tax deduction and credit available after you're organized, as well as choosing between the two when necessary. 10. Give yourself a break. Budgeting and preparation can appear to be full of shortcomings. Make sure now and then you reward yourself. You need to enjoy the fruits of your labor, whether it is a holiday, a purchase, or an occasional night in the city. Doing so provides you a taste of the financial freedom for which you work so hard. Last but not least, when needed, don't forget to delegate. It doesn't mean you can, even though you might be skilled enough to do your own taxes or handle a portfolio of individual stocks. It could be a good way to jumpstart your planning by setting up an account at a brokerage, spending a few $100s on a certified public accountant or a financial planner at least once. That was all for today's video. Thank you for watching. Like, share and subscribe to our channel. Data is everything.